Alright guys, welcome to the video. I'm going to be reviewing buying and selling, when we buy, when we sell, why. It is going to be a one-size-fits-all video, so if you're a beginner, you do not know anything other than what a stock is, like why stocks exist in the first place. If you know more than that, you're going to understand this video. If you're advanced, still going to have value to you because, look, we all need a little bit of a refresher, don't we? So, we're going to get into it. I'm just going to start by covering why we buy momentum stocks, why we trade breakouts to begin with. So, if you are a beginner, I assume you have come here for the right reasons to make money, but you also know that I trade breakouts. So what does that mean exactly? Well, it all starts by chasing momentum stocks. A momentum stock is a stock that has a lot of upside strength, right? So it's moving consistently to the upside, right? So let's just say the stock was at $10 here, 20 bucks here, right? It's just consistently moving higher, right? 100% plus move, right? So we're looking for stocks that are moving a lot and are showing strength, right? We're not looking for stocks that are chopping like this higher. We're looking for stocks that are pretty much straight up with little staircases in between, right? So, step one, that's the momentum stock. Now, the breakout is important to us because it allows us to have an optimal risk to reward. Now, I'm going to get into that in a later video, but from a technical standpoint, this is how it looks, right? You have a big move in the stock, and you're going to get a little bit of a staircase, right? So typically, you're going to see support resistance, and the chart will tighten up. Why this happens? Well, stock's made a large move. Let's just say it's made a 50% move here. There's some profit takers, right? Let's say you were in this stock. You're up 50%. So some people are taking some profits, right? They're ringing the cash register. Others, buyers, investors that are still interested in the stock are holding it up. So there's profit takers, but the stock isn't plummeting, right? So that's good because if a stock is strong and it's not dropping when sellers are taking profits, we know that there's a chance that this stock can move a lot higher, right? So the momentum is still there. Now, our goal is to buy on this next wave higher. So it's eventually going to break out of this consolidation. Consolidation refers to this period right here, right? Contraction in the stock, where the stock is tightening up, right? Where you have some sellers and buyers, and they're meeting at a certain price. The sellers run out of stocks to basically sell, at least at that period, at this price, and buyers have pretty much loaded up their boat at that price, right? So beyond that, once a stock breaks out, it unleashes the next wave of momentum. There's more buyers that want to chase that move higher. There's FOMO, etc., right? And there's going to be people shorting the stock that are covering. So basically just a big wave of buying comes in, and basically you get this, right? You get a staircase, move higher, and so forth. Go look at any stock ever that's made a big move. You know, if you know of a stock or even crypto that's made a large move over, let's just say 3 weeks plus, you're going to see this. Right, you're going to see a pump, and you're going to see a staircase. A pump and a staircase, pump and a staircase. Right, so these staircases allow us to have great entry opportunities. So that's what we're going to focus in on today. Now, consolidation, right, which is aka the staircase, it comes in different shapes and sizes. But for textbook examples, we are pretty much going to review one variety, which is a flag, right, which involves making lower highs and higher lows. Right, so the stock will do this. Right? This is what we're going to review today. Now, there's a couple others we focus on as well, but this is going to be the primary focus. So let's look at a few examples. This is NNE. This was one of the best trades from last year. I'm actually in it right now, but this was one of the best trades of last year, so we're going to take a look at this. So NNE at the time was a new IPO, right? This is the first day the stock had ever traded publicly, right there. So when a stock first trades publicly, there's a lot of hype typically because there is no fair price for the stock, right? The market really hasn't decided what a fair price is. As a result, it's going to be a lot more volatile. It's going to make large movements, right? Because the market's still trying to price it out. So when we have big movements and in one direction, you have a lot of momentum, right? So there's two ways a stock can be volatile. It can just be choppy like this, or we can have a lot of large movements, but in one direction, right? So that's what we're looking for. So NNE, right, made a nice little move that initial day. It went from $3 to a high of $6, basically, or $3.50 to $6.40. So just massive move day one. As you can see, the stock's moving a lot. Now, these candles look pretty small, but they're still moving quite a bit. But anyway, what you see here is a contraction, right? So like I just said, higher lows, lower highs. By the way, each candle right here is 1 day. See how it says 1D? That refers to 1 day. Every single candle represents one trading day, right? Most people watching this video should know that, but I just thought I would say it anyway. So what we see here, the stock is contracting, right? It doesn't necessarily take a genius or even someone that knows stocks to understand that the range in which the stock is trading is tightening up, right? So that's what we just talked about. The stock is, for the most part, making higher lows, right? This low, the low of this day right here was higher than this day, and this one was higher than this one, and so forth. And it's also contracting by making lower highs, right? You can see that. We're getting this contraction pattern. Now, this is exactly what I said before. So there's some profit taking throughout this move here. A little bit of fear comes in because the stock is brand new to the market, right? So it makes new lows. It's brand new to the market. You know, people don't know where to price it. They're scared. They don't want to bag hold. They don't want to lose a lot of money. And then buyers say, no, we want to push it higher. So anyway, you have this back and forth until there's an equilibrium price in which buyers and sellers have pretty much are starting to sort it all out, right? The buyers that wanted to buy at those lower prices are already in, right? And the sellers that wanted to dump their ammunition have already done so. So beyond that, you have, and by the way, guys, volume. I haven't mentioned volume yet. This right here, these bars down here refer to the amount of shares traded every single day, right? So the initial day of trading was the most volatile. It made the largest move. You have this massive stick of volume. The other days where, like I said, it's contracting, the buyers and sellers are starting to find an equilibrium price, the volume is significantly lower. Now, at the end of any range, right, at the end of any flag, this like setup we're looking at right now, you want to see volume get very low, right? That means that the stock price is pretty stagnant, and it tells us exactly what I just said. Sellers are done selling, and buyers have done what they needed to do as well. So when you have very low volume, now the next wave comes in, it's a new wave of buyers, and the stock sees massive explosion, right? That's what we're looking for. So that's exactly what we get. Now the next day you can enter, right? This goes to the buy, right? You have a large amount of volume. You'll see 5 minutes into the day that the volume is really large, or significantly larger than the previous day. Here, I have to zoom in a little bit, but as you can see here, the volume in this day was significantly larger than the prior day. Now, for our entries, there's multiple ways you can do it, but for the most part, I would just say outside of this range, let me delete some drawings here, right? Above the prior day high is a good rule of thumb, or you could just say, you know, outside of this little drawing right here, this little trend line, you know, outside of that trend line with strong volume, that could trigger an entry. But let's just say you enter here at the above the prior day's high, right? So this right here was the high of the prior day, and above that is a solid entry point, because you're not going to have a strong breakout day if you can't get above the prior day. So that's a good rule of thumb, and especially if the volume is really high, second indication that it could be a very strong day. So anyway, that's your entry there. Now, your stop loss, where you would sell in case this, you know, turns into a loser, good rule of thumb is low of day, right? So in this case, it would be around 395, right? So you're entering at about 414, your stop loss is 395. That's a pretty solid, you know, textbook setup. The tighter your stop loss, the better. I'm not going to explain that just yet. But anyway, I just wanted to explain why we're buying, right? You see a lot of volume. We understand this has the potential to squeeze much higher, and that's exactly what it does, right? So the stock goes from about $4 to a high of 10, right? So we have 3 really, really strong days in a row with a lot of volume, right? You want to see a lot of volume come into the stock. Now, after that, you see another staircase, right? This is another staircase. Like I said, when stocks have a lot of momentum, you're going to get these staircases, because now, let's say we got in, right? We're going to take some profits here. It made a huge move. We're seeing it dump the next day. We want to take some profits. And the next day it also sells off because they want to take more profits and they're scared, right? We don't want to lose everything this was a huge move the stock just made, and it's dropping 2 consecutive days. We don't want to lose everything, you know, we just made. So there's more profit taken. Now, after that, you have some buyers step back in, and look what it does, right? We're seeing lower highs and higher lows, right? This is pretty much the exact same setup, right? Now the candles are a little bigger now, right? Because we're dealing with bigger numbers. But anyway, it's the same exact thing. And look, the volume, right, also drops off, right? The volume was a lot higher here, and it dropped off. Look, every day the volume was lower than the prior day. And then look, the next day, you have another explosion in volume, right? You have more buyers stepping in. So they found another equilibrium price around $7 or $7.10. Next day, there's the next wave of buyers come in. So you could also enter this, right, like I said, above the prior day high. Now, there's so many intricacies with this stuff, but I'm just giving you guys the bread and butter, the core fundamentals, the layout of where you're buying and selling. So if you were to place every buy you ever made at high of day, that would be the best rule of thumb. So that's like the most standard entry, above the prior high of day. So in this case, the prior high of day was about 740. So above 740, you can see the volume's coming in really hot. So this would be a great entry. By the end of the day, the stock's at 930, right? So it's already up $2 from that entry. Now, after that, we have another just explosive move, right? Where the stock goes from our entry of 7, well, our original entry was 4, then we entered again at 7 potentially. Stock goes all the way to 37. You know, these are ridiculous numbers. This isn't every trade. This is a textbook example. But look, every single day, it was basically closing higher than it did the prior day. So that's the important thing. Massive run. This is what we call momentum, right? When you have a stock that's moving a lot, but in one direction, right? It's not chopping around. All the energy of that stock, all the buying, all the, power the stock has. There's a lot of volatility here, but it's all in one direction. So that's what we're looking for. Now, someone could also can point out and say, look, it was setting up again, right? And exactly, right? You had 2 selling days, just like this one, 2 selling days, right? And it tried setting up again, and it did, right? Lower highs, higher lows, and it didn't break out. So you wouldn't have bought here, right? You would have just been selling. So if the stock doesn't break out over the prior day high, you're not buying the stock. Now, you could have bought here, because it did break out there. That was, you may have gotten faked out, but you're up a lot anyway. So the point is, if it doesn't break out, you don't buy. Because if it doesn't break out, you're not going to get a continuation of momentum. So now, for the selling component, right? So we went over the buying, right? As much as I could in, 10 minutes. Now we're going to go over the selling component. So, let's just say we bought at $7.10, we bought at $7.40. Right, say we bought like somewhere here, $7.40. And then say we originally bought at like $4, right, somewhere there. This is what our sells would look like. So there's 2 ways to sell. There's what's called selling into strength. So let's just put SS, which is selling into strength, and then there's selling into weakness, right? So let's go over the 2 and distinguish them, and I'll, help you figure out when to use which. So selling into strength refers to taking profits when the momentum is really strong. Right, so like you're selling into if the candle is just ripping, the stock is on fire, you're selling into that rally. So the downside to that is you are capping off your gains. The stock is on fire and you're selling it. So for example, you could have sold here at 11.50, you could have sold here at 20, you could have sold here at 9. Those are all examples of selling into strength. The issue is the stock each time proceeded to move a lot higher, right? You may have sold at $7. You're up a good 30-40% from this entry. Or no, sorry, even more. This was a $4 entry. This is $7. You're up a good 75+% there, right? So you could have easily sold there into strength, right? So selling into strength is good because you are locking in gains, right? You don't want to lose gains. Oftentimes stocks can crumble, right, after one big day, and those gains that you could have had slip away. So that's selling into strength. Now, selling into weakness is when you're using the moving averages. These lines here that trail a stock. Right? They basically calculate the average price over a given window, right? So this red line here is a 9 moving average. So it's the average price over the last 9 days, and this is the average price over the last 21 days. The 9 days is going to be more sensitive because when you have smaller amount of inputs, you are going to get a more volatile result, right? I mean, that's just basic math. I mean, if you don't know that, just give up. So anyway, the point is we're using the moving averages to gauge momentum. When a stock has momentum, it is comfortably above both moving averages, which you see here, right? Above both moving averages by a lot. So selling into strength, just to go back to that, refers to capping off your gains at these strong moves. But a pro sells into strength when they see a huge divergence between the moving averages and where the stock is. For example, when it was at 37 here, you have a huge spread between the moving average price and the price of the stock, right? When you were here, it was right, it was very tight. The moving average was like right on top of the stock is right on top of the moving average. When you push all the way to 37, there's a huge separation. So a pro sells into strength when the separation between the moving average and the stock is huge. Now, going back to selling into weakness, which is the main point of using moving averages, is if a stock's above its moving averages, it has a lot of momentum. If it's below, it doesn't. So we bought the stock with the anticipation of momentum continuing, which in this case it did. But once it goes below the moving averages, like it did here, there's no point of being in anymore, right? The momentum is dying. It's losing momentum. So there's 2 ways to do it. typically the 9-day moving average and the 21-day moving average are good moving averages to use. You can use 10 and 20. They're very interchangeable. The point is, when the stock goes below the moving averages, the momentum is gone. So there's two moving averages that I typically use, right? The 9 and the 21. When it goes below the 9, you could sell around 30 to 50% of the position. When it goes below the 21, you should be out of all of it. Now, when I say goes below, that can mean many things. It has to really close the day, right? If the stock closes the day, so at 4 o'clock when the market closes, if it is below the moving average, it is time to sell. So in this case, for the 9 moving average, it went below it on this day right here. This was right here. You have closed around $25. The moving average was slightly higher. If you didn't sell on that day, you would have definitely sold here, maybe here. You could have sold on any of these days, right? For around $24, $25. The second moving average, the 21, it closed significantly below it on this day at 19. So this is it. You would have closed out your position between $24 and 19 selling into weakness, right? SW selling into weakness. You would have closed your position between 25 and 19, right? Which leaves you with a really good profit. And look at that. After that, the stock just dies, right? Because the momentum is lost. And when a stock's made such a massive move, especially off of an IPO, typically that hype dies off. There's a lot of hype behind this, right? Because if it wasn't a hype move, it would have been, most of that would have been priced in upon their initial offering, their initial IPO. Most of these stocks that exhibit huge waves of momentum are hype moves, right? It moves based on hype, right? So there's a lot of FOMO, there's just a lot of emotions. So anyway, once the momentum dies, so does the stock typically. And again, it can set up from there, but the move that we were looking for was over, right? Pretty much full circle right there. So that is the buying and selling. Let's go over one more, and then I'll call it for this video. And I can do I can go up to part 1,000 on these videos where we're just reviewing different examples of setups. But this was one of my favorite, most textbook examples. Let's take my most textbook example from this year, though. NNE was a trade I did last year. So EAVA, or AEVA, I always get it backwards. This was just such an amazing setup. So, and I was using this as an example to some people when I was teaching them before it even broke out. So this is the most textbook example you could possibly find, really. So the stock makes a big move. It goes from, what is that? I have a light in my way. It goes from $2.70 all the way up to $7.50, right? So you have just a huge move right there. I mean, stock's like 300% move, right? Every single day the stock's moving higher. Every single day stock moved higher. After that, right, so there's some selling, right, some profit taking, there's some indecision. The volume is dropping off. Look at that. Look how much volume there was here. That just drops right off, right? So a lot less shares being traded because sellers are pretty much getting out. Buyers, they're interested. There's investors, there's firms that are interested in scooping up shares at these prices, so basically you're getting just a trade-off between buyers and sellers. There really isn't one group leading, right? Sellers aren't taking over, otherwise the stock would be plummeting after a big move. And buyers aren't taking over just yet because otherwise the stock would be skyrocketing higher. So we have this indecision, we have this equilibrium price of about $7.14, which is funny because that's about the same as the NNE example, literally to the cent. Just a coincidence, obviously. So the next day you have this big bump in volume, and it breaks out of this range. You can see, right? It was making higher, lower highs, higher lows, right? It was getting tight, and then it's popping out of this little formation. I mean, look, it doesn't take a genius to see this. I mean, anyone with 2 eyes and a half decent brain can understand that this is a breakout, right? It's breaking out. I mean, you could just kind of figure it out for yourself at this point. But so this is a textbook example. So it's you take trades like these. I mean, it's pretty hard to lose money. But anyway, from there, it just goes up every single day. Every single day. This would have been the first day to sell, really, if you weren't just selling into strength. I mean, if you're selling into strength, there was pretty big separation right here. So, maybe you're selling somewhere around $13, which is where I got a lot of my sells off, selling into strength. But if you were to sell into weakness, this would be the first day to do so, where it closes below that 9 moving average. Now, it doesn't close below the 21 moving average until this day right here for $26 per share, right? So this was just such a massive move. It went from 7 to 26, up basically every single day. I mean, this thing was so powerful, so consistent, and just really textbook all around. There are also less textbook examples of buys in areas like this. This was a buy opportunity. Now, we didn't review it in this video, and it might seem a little foreign, this setup, but this is a key level, right? Whenever a stock can't get through a level, that becomes a resistance. And getting through a resistance point, you can see like the prior days, it was trying to test this level, getting rejected. This isn't textbook, but this is more intuition based. You start to see this once you get more advanced, breaks out the next day, and it moves higher. Now, not textbook, but this is what we're focusing on as far as the textbook setup. For, in part 1,000, you'll see a lot of non-textbook examples. But anyway, this is probably the most textbook trade of the year so far. So anyway, guys, that's the video. It's 25 minutes already talking about buying and selling. So in this video, we covered why, like the most textbook example of a buy, which would be like a flag, right? You see a tightening range, and then stock blows up with strong volume. And then the next thing we covered was how to sell it, right? Selling into strength, right? Where you're looking for just a stock to make a big move, and you're just, you're capping off your upside, but you're locking in your gains, and you're also potentially looking to see the spread between the moving averages and the current price of the stock, and then selling into weakness. When a stock loses momentum, starts dropping below its moving averages, you're selling, which if the trade goes well, the stock had momentum after the breakout, you're doing well either way. So thank you guys for watching, and I hope you guys enjoyed the video.